two of my good friends. You got a classic entrepreneur and my friend John Levy, John Albright, the guru of venture and private equity. We have some really good, tough questions.
So I brought about a dozen hats, okay? And if you ask a really good question to either John or I, you'll get a score hat.
The course is about corporate social responsibility. What does corporate social responsibility mean to you? How would you define it, John?
I think it means a lot to an individual. And you know, I guess the question is, what does it mean to me personally? What does it mean from a corporate?
From a business point of view.
From a business point of view.
And be sort of short.
Okay.
Okay,
in our particular case, it really is a reflection on the people who work there. And corporate responsibility can mean a lot of things. It means in terms of, you know, treating people equally, treating people fairly. How many women do you have working in your environment? How many women on your board? How do you deal with social issues like giving back to the community? There's a whole host of things. And typically, what I find within our organization is if you sort of set the standard on a personal basis, it reflects throughout the whole organization. Okay. So that's what we do.
Albright?
From our point of view, the only role corporate social responsibility plays in what we do for a living, what our companies do for a living would be, you know, we don't invest in any companies that have anything to do with drugs or alcohol or anything criminal. That would really be the end of it. And then everything else after that for us would be sort of on a moral basis. But we don't invest like some of the social venture funds. We don't invest to improve the environment or the world or anything like that at the cost of making money. Right? So there's rules that we have to respect, but we don't do it to make money.
Okay. Ask who a question. Go ahead.
Sure, our investment in theScore was a charitable contribution. What's the question?
No, I'm just thinking, as the world changes though, and you manage a lot of money and you're looking at a lot of investments, and one that was been particularly hot over the last couple of years is all the marijuana stuff.
Yeah.
Now, I'm not really asking did you or don't you, because I kind of know, but how do you view it as the world changes like that? Like, you know, where before you probably didn't want to touch it, then all of a sudden it not only becomes in vogue, it looks like it's going to become completely legal over time. Yeah. So how do you deal with stuff like that?
That would be okay. Like for medical purposes, yeah, I think that would be okay
to invest in it, which is what they all are.
Yeah.
Right. Okay.
Let me follow that up. I'm going to go out of order here because there are some questions on impact investing. So where's Sarah Kelly? There you are. So there's a question for both, actually.
Thanks. Hi. So according to the 2016 Canadian Impact Investment Trends Report, impact investing is experiencing rapid growth in Canada. This increase can be attributed to the increased consumer demand for environmentally and socially conscious companies. Mr. Levy, with growing consumer pressure, how do you incorporate social responsibility into theScore's overall strategy? And Mr. Albright, do you allot a certain percentage of funds to sustainable startups, or is CSR something you generally keep in mind when deciding which startups to invest in?
Okay, so mine's pretty easy. Ours is really a pretty easy company in that regard with respect to social responsibility. We're in the sports business. You know, it's about fun. It's about passion. It's about people being engaged. You know, what we have to be sort of sensitive to is, even though, for example, getting back to the male-female split in terms of social responsibility, you know, sports has predominantly been a male domain. But over the last number of years, that changes. And how we compile our data and how we output and how we look at our audience has got to change to reflect that. So, for example, with, you know, big movement in women's soccer, or big movement in all sorts of women's sports, that really drives us from a business standpoint and from a social standpoint to be responsive to it.
Sarah, we don't allocate any money for social impact out of our funds at all, so we're a purely for-profit company, and I think a couple of years ago I was interviewed about this, so we do invest in mobile education. We do invest in the consumerization of healthcare. So different sort of software and hardware that's used at home to improve people's lives, and telehealth with psychiatrists and stuff like that that can help people online using Skype or whatever. But that's just a coincidence. So when we look at every quarter, we make an investment about once a quarter, once every 3 months. And when we look at what's at the top of the queue and what's going to earn us the most amount of money, if we had two equal companies that both had, great management and a great product and a great market opportunity, and one had social, one didn't, we'd probably go with social. But there's no way that we would go with social if it was a less of an opportunity than something that was purely for profit. And then what we try and push in our companies is sourcing developers in parts of the world where they're paid properly, or if we have like hardware software companies, which we have several, that the hardware is made in the appropriate country by the appropriate people and they're paid the appropriate wages and stuff like that.
A couple of questions on women in sports. Allison.
Okay, there's a fast-growing female audience for esports, and websites and apps such as The Relish and Female Fan are focusing on targeting and attracting female sports fans. What is theScore doing to appeal to women, and does this involve a strategy to increase the number of women currently in the organization and on the board?
Yes. Again, in the spirit of not only just trying to be socially responsible, but to do good business, the sports world is changing dramatically. So if you're not reflective of that, and I'm not just talking about, putting pretty women on a desk to report on sports like some networks do, because that's never been our style, never. And
You're getting a dirty look from Victoria here on that one here.
well, that's the answer that some networks, I don't know, sorry, Victoria, if I offended you or anything like that, but, that's not, I think, addressing the real issue. The real issue is, women have been involved in sports. They've been ignored in sports for years and years. And now, finally, that there's a growing audience for it, people are becoming more receptive. So in our particular context, we've always tried to be open, honest, and authentic about everything we do. And, I would say we are a little behind in terms of senior management positions, yes. Board representation, yes. We do have a great woman on our board, but is it enough? No. Do we strive to improve that? Yes, on a daily basis. So the bottom line is, if you ignore that and don't deal with it properly, you're going to get your ass handed to you in terms of business anyway. So even if you weren't open-minded about it, like I hope everybody in my organization is, you better be, otherwise you're in big trouble. Sorry, yes, Paul.
I guess I was just wondering on that, explicitly when you say looking to improve on a daily basis, what do you mean by that, on a daily basis?
Okay,
You get ahead. That's a good one. I was going to ask him that question. What do you do on a daily basis?
Okay, so on a daily basis, we continuously review who our audience is, what our audience is looking for. I'll give you another example. So over the last number of months, as you may or may not know, we did a major revamp of our app. And our app really, which is amazing, it's great. I love it. Everybody who works with us loves it. People who consume it love it. But it went through a major overhaul over the last 6 months, actually the better part of a year, actually. And what we did is we started to take all this amazing content and push it out over other social platforms, rather than just on theScore, with the hope that we get our brand extended and eventually draw people back into the app or monetize on these other platforms, assuming Facebook allows us to, or Instagram allows us to, or we're able to partner with those guys, which is a work in progress. But one of the side sort of cars of that is it's a different type of sports reporting now. It's a more social sports reporting. We're broadening the type of interest that we can generate in our audience in terms of how they consume sports. So there's another example of how it's not just a male domain anymore. And a lot of the information, a lot of content, a lot of the humorous stuff, a lot of the side stories that we're telling are interest to everybody and not just the male-dominated sports world. So we're very extensively working on expanding our user base and appealing to a broader base audience, which includes the other half of the world that we live in.
How many people use the theScore app? Okay, how many females use the theScore app?
How many female users do you have?
It's hard to, because we, only through registration, and about 50% of all of our users register, and we don't specifically ask male, female. I don't even know if you're allowed to or not allowed to. We can start to gather from third-party data and from all sorts of data who is who. We estimate that now it's about 20%, 15 to 20%.
Okay, we have a question, women in venture capital for John Albright from Rupin. Where's Rupin?
Looking at your current portfolio of 34 companies that you have on your website that you've invested in, only one was found to have a female founder. Why is this rate so abysmal, and what issues are you accounting that is preventing investing in female-led startups?
Okay, it's a statistic that is sort of a result of the world we live in. It's not as a result of the way we investigate opportunities, right? So most of the companies we invest in are technology-driven companies, which are graduates from engineering, computer science, mathematics, those type of backgrounds. And as a result of the enrollment in those faculties, which is around 20%, the number of deals that we do that are led by female founders is also viewed that way. So if you look in the United States, roughly 17% of startups are female founders. If you look at what we do, we might invest in 1% of the companies that we speak to or come to our office or come to their office. So, it puts us at about 0.17% in terms of percentages that female founders, given like 17% times 1%, right? So it's almost physically impossible for us to do better unless, like the social responsibility answer that I gave to Sarah, unless we're to say like, okay, if I'm going to do a female founder-led deal at a less opportune rate of return than a male founder or whatever the standard is, we won't do that, right? So they would have to be equal footing, equal base, same opportunity, and in that case, we'd probably like overweight on the female side.
Question on the scores business performance from Kyle and directed to John, but to you, John Levy, as management. But Albright, I'd like you to think about this answer as a shareholder. Let's see if management and shareholder have the same answer.
All right. Looking into the MD&A for theScore Inc., it seems as though there's a cash liquidity risk looming in the near future, as there was a decrease in cash equivalents of $16 million in 2016 and $5 million in 2017. As a prospective investor, how is the company looking to maximize shareholder value with its remaining cash reserves and new update to its flagship app? And how will the company entice more people and advertisers to use the Score Inc.'s platform, given that there was a reduction in spending for marketing in the growing sectors of fantasy and eSports?
Did you give him this question?
I think you should get a hat right now. I think you should give him a hat. Seriously.
All right, he gets a hat. He gets a hat. He gets a hat.
You notice he's stalling so he doesn't have to answer the tough question. That's what he's doing here.
Okay, so let's talk with the most, I think the most, well, I shouldn't say the most important facet or aspect of that question, but the first thing you mentioned was is there a cash crunch looming or something of that nature? And the answer to that is no. Basically, we have stated, and if you look at the increased revenues that are being generated and the management of the cost base as to our operating costs, what we've said publicly, and I'm confident, is that we have enough cash on hand to get through to cash flow break even, which we are planning to happen this year. And this is, I'm not telling you anything we haven't said to the public.
This fiscal year.
This fiscal year. Sorry, and our fiscal year starts in September, so we're just into the first quarter of our first year. And we're on course for that, and we believe that that's going to happen. And I should also say that that's something that's very important to us, because we're in the business of building businesses. We've done it a number of times, and I think this is the most exciting one that I've ever been involved with, to tell you the truth. I think it has the most opportunity, it's most broadly based, and we also have complete control over how the operations are occurring, which is also a luxury that we have in our particular case. And nobody wants this to happen more than us, because you're looking at two of the biggest investors, myself and Mr. Albright here.
And the smartest one here.
Sorry.
So basically, we're very confident that we're going to be able to get to cash flow break even and then continue to be the masters of our own destiny, because the last thing you ever want to do in running a business like this is have to go to ask for money. You want to be in a position where it comes to you and you don't have to come to it. Now, in terms of how we're going to do it, a lot of that has to do with the efforts that are undertaken on a day-to-day basis, the growth that we've seen over the number of years, getting back on the growth train by relaunching our new app, by taking new initiatives, by looking at new opportunities, by continuing to invest in stuff like eSports and Facebook Messenger and bots and all these new, and Alexa, which we're on. So there's no set formula, but what we try to do is respond to how the consumers are consuming our content and collectively build this community who love our brand, love our product. And then on the other side of it, once you do that, the advertisers have got to come through you, and that's what's happening. Our revenues are increasing every year. This year is going to be no different. Advertisers aren't stupid. They know people aren't watching TV like they used to, and they're consuming all sorts of content, but particularly sports, in different ways. So we think we're really well positioned to be able to continue to grow and probably end up being one of the best businesses I've ever been involved in.
Okay, I got a similar questions, follow up for both of you. Again, the operation, where's Manuel?
So I did a research on the stock price and tried to correlate it with the news that I found about the score. And I found, an interesting trend of good news starting in 2013, before, the good news like being chosen as one of the 100 best Android apps, and that put you in a very good position to get funding, $17 million in May 2014. And then more good news, best sport application for iPad, Puma's mobile partner, one of the Business Insider graded apps. And that also put the stock in a very good position for the next round of investing for a $26 million injection. And then the innovation continued, because that's where you released the application for Apple Watch, and that's when the company saw the best price, the stock best price ever. Well, at least since its separation from the network. But from then, the good news stopped showing up as frequently, like no more innovation, just minor design changes. At least I'm talking about what I found online. And this coincides with a steady fall of the stock price, getting to the current price, which is the lowest, the all-time low at only 13 cents. So the question is, what happened?
Okay, so just in terms of your research, and I think, I applaud you for trying to match up where we've been and what's happening and how the stock price reflects. I too watch it on a minute-by-minute basis, a day-to-day basis. I'm not 100% sure you can attribute the price of the stock exactly to the things that occurred during the course of the last 3 or 4 years. Quite frankly, and most of the time, I'm at a loss to know why the market goes up or why it goes down. I know, for example, if we're just talking stock price, why it got to its maximum price at one point in time. And it was because there was, firstly, gaming was very hot in the marketplace in Toronto, in Canada, and the TSX Venture Exchange. And people were thinking that there was going to be some sort of deal. Don't ask me why they were thinking, but the market, either the industry or the brokers, because there were all sorts of deals circulating, and because it's a natural thing to happen to us, because we are, and still are, the second most popular app in North America. So all the stuff that we've built continues to be true. And the stock escalated dramatically. Coincidentally, just before that, when we did the raise at 67 cents, we didn't go out and do that. That came to us. I was sitting in my office one morning, and John was aware of this, and one of the bankers came in and said, we want to do a bought deal, and literally it was done in 3 hours at that price. So they too got excited by the positioning of the company and where they thought it was going. What we're doing is building a real business, okay? And yes, the stock price today is in crap. What that does, however, is give an opportunity to people to come in at a very inexpensive price. If they believe in us and they believe in our product and they believe where we're going, it gives them an opportunity to get involved in our company and see what we can do. I don't think there is a direct correlation. Over time, it will correct as we move through to cash flow break even and start making money. It will correct as some of the initiatives that we're taking right now, whether it be some of the ones that I mentioned before, start to either generate cash on their own or generate some excitement. It will happen when we get back on our growth train. And then I think it's going to explode. I mean, what CFO or CEO doesn't think that? But I'm not the least bit concerned. I hate the fact that it's at wherever the hell it is, 13 cents. I mean, it makes me puke every morning. But it does not concern me in the least in terms of where we're going, what we're going to do, or what we're going to be able to accomplish. So, you know, I told you before we're going to be a cash flow break even, but if at some point an opportunity comes up and we needed money or we wanted to buy something, which we're always looking to do, or looking at other opportunities, you know, I'm convinced we could raise the money. I'm not sure I want to do it at this silly rate, but I know we could do it. And we would be one of the investors in it because one of the things that's occurred as we've raised all the money is myself and my family and John have continuously reinvested in the company.
Yeah, I'll add two things.
No, I'm interested in your comments.
Okay, so two things. One is, actually in your comment back there too, and yours right now, I care a lot about those, and those are things that John's been hearing from me for the last 18 months, right? Like all the time I'm annoying him. As an operator, I'm annoying you. So there's two things. One is like, I believe the company is very undervalued. So one of the things I continue to sort of bother John about is like, why don't we take the company private at 13 cents and we'll own it because no one else has to believe in it. As long as we believe in it, that's great. And we'll build it. The company's not being valued for its social viewers or their social users, right? So if you look at this at the main, this is all my opinion and only mine, but the main app has around 4 million users, and the 4 million users are worth $10, $20 per user, depending how you value them, or even more, right? And as that continues to grow, that stock price, almost on a linear basis, reflects that. And if it grows at an exponential rate instead of linear, then the stock price will too. We're not getting any value for the, I think publicly we say more than 30 million.
Over 30 million.
Over 30 million users / viewers of theScore's content in Facebook and Instagram and Twitter and all these other things. And that is something that, you know, and the one part I'll agree with John is I don't know why we're not getting valued for that. But if one of the other social network companies in the world were to decide like, geez, I need to own a sports properties, like a Facebook or an Instagram, which is owned, but Google or one of the Valley-based firms decided.
Amazon.
Yeah, I wanted to have like a lot of sports users for whatever reasons. If they want to pump ads to them for e-commerce to play a football or a basketball or a hockey stick or whatever, they're going to take advantage of that 30 million plus users and start targeting them, right? So to them, they would see the value. Unfortunately, whoever the holders of the stock are, outside of John and ourselves, in this city, they're probably sitting all in Toronto too, they don't value it or they don't understand it and they don't get that an acquirer will, right? So
that's another interesting point. 65% of all of our users come from outside of Canada. It's a US-based service, basically. 65% are US, 20% are Canadian, and the balance are rest of the world. We don't even touch the rest of the world in terms of really talking about the opportunity and with respect to international sports and soccer and all that. We have a very, very small shareholder base coming out of the States. And one of the things, as we gain momentum and as we start to move in that direction, what you're going to see is a much more intensified effort in our informing the market south of the border as to who we are and what we are. But in terms of the overall long-term positioning, we're sitting in such an amazing position. I mean, look at the companies getting involved in sports. You know, And what's really, really interesting is, sorry to ramble a bit, but just in terms of the opportunity and why I know this is going to be a $2, $3, $4 stock at some point in the future, is because, these big companies with huge cash are seeing sports and seeing this migration from the legacy media, sports media companies like the NBCs and even ESPN, who are getting their token standing to them over the last little while. But what they're doing is they're coming in and they're playing the rights game. They're buying rights for the streaming services, right, on their new platforms. So they're falling victim, in my view, to the same thing that the networks, the traditional networks, the CBSs, the ESPNs, the NBCs, the Foxes have done over the past 10 years. All they want to do is show the game. The only thing we don't want to do is show the game. So I love the fact that they're involved, that they're paying huge bucks for this, that they're seeing value. And why wouldn't they? I mean, there's nothing like sports. Think about it. Where else is live? What else is alive? What else? You have no idea what's going to happen, yet everybody thinks they know, because we haven't even started to talk about gaming, gambling. We know a high percentage of all of our users gamble on sports.
Not very social, responsibly.
That's a whole other opportunity that I think is right there for us, as it opens up, as it will, because there's a court case right now in the States challenging PASPA, which is what restricts sports wagering to just Nevada. So the fact that the big guys are getting involved, they have all sorts of cash, they're just interested in the game itself. John's 100% right. At some point, they're going to look around and say, who else is dealing in sports and who has a big universe of users and engaged users, and they're going to come knocking, and I'm going to tell them to go screw, because we're going to continue to build this thing for a while, just like we did with the rest.
Okay, question from Pervinder. Where's Pervinder?
So the Score app is it's considered among the top app for latest sports news and live score here, as you mentioned. I belong to the country where cricket is the most followed game, and I've been using ESPN app there, which is specifically created for the Indian market. So and when I searched for it, and even you told like you haven't touched the international market, my question was like, is there any plan for expanding the Score app for Asian markets?
The answer is yes. I mean, we really do see it as a global product. But in the formative stages of our development, it's important for us to nail it in the North American market first, in terms of establishing ourselves, establishing the credibility, getting to a point where we're making money. But having said that, cricket in particular is something that is of a lot of interest to us. And as I mentioned earlier, we launched this thing on Facebook Messenger called the Score Bot. And I don't know if you've ever used it or seen it, but cricket is a big part of what we offer on Score Bot. And we just sort of fell into it because all of a sudden people were searching. We thought they were searching for the Cleveland Indians, and what they were searching for was their favorite cricket team in India. And it's a true story. And we researched it, found the content, and actually now have hundreds and hundreds of thousands of people on Facebook Messenger bot for our cricket offering. So yes, we're interested in markets. It's very difficult to monetize there at this point. A, because the market's not as mature in terms of the advertising market, and B, we don't have enough numbers yet, but it's something we're definitely interested in.
In August of 2012, you struck a deal to sell Score Media to Rogers Communications. The sale was crafted in a way that allowed you to keep and grow the digital assets. Reports said that you were looking for $200 million and penned a deal with Rogers for $167 million. Now, as an entrepreneur, how do you decide when it's time to sell your business, the business you put so much time and effort into, and what implications are involved in making that decision?
Yeah, well, it's particularly tough. I mean, John will probably has seen it on an objective basis because of the companies he invests in, but you're right. It was a lot more difficult for us because it was our baby. It was something we started in 1994. Actually, 96 we got our license. We grew it from nothing. I think it's all timing. It's timing, and it's, and you got to get the right deal. And we got lucky on both, to be quite honest. And you got to be good to be lucky and lucky to be good. Rogers, Cogeco, other companies have been knocking on our door for years, and we kept shooing them away. And basically, the reason we ended up doing the deal was, quite honestly, because this whole app business and the digital business was looked to us like it was in a state that it no longer had to be incubated inside our media company, and it was time to birth it, and it was time to let it stand on its own 2 feet. And Rogers woke up, and even though I was asking for, if you don't ask for 2, you're not going to get 167.5, right? So, and 2, he was getting it cheap too, but we didn't get all that. So you put a value on it, market dictates what it's worth. What's really interesting, and the only thing I'll tell you is, in a deal like that, money was very important to us, obviously. It was not that important to Rogers. $167 million to them was like lunch, to be quite honest. In fact, it was not even material. They didn't even have to report it. We were going up, down crazy and writing press releases, and they didn't even give a shit. That was just 167 million. Once they wanted to do a deal, within reason, the money was not the object. You know, once I shook hands with Edward, actually, and said the deal was done, it was done. And so it was just timing, and we got the deal done, and it was the best thing that ever happened to us, because even though, one other sidecar, even though the TV network was irreverent, it was different, it wasn't your typical TV network, it really was sort of holding us back from the full development of the mobile asset, because that was the cash cow. That was the one making money. This thing was just this infant, and it's a different business, and you have to think differently about it. Everything we were thinking about and I think one of the reasons we are so successful, and we're going to be so amazingly successful in the future, is because we're one of the only independent digital mobile companies in North America, in the world, actually. We don't have any ties. I don't have any legacy shit to worry about. I don't have to worry about my TV network. I don't have to worry about my internet business. I don't have to worry about any of that crap. I only have to focus on one thing, and that's you guys using this app, or using the next adaptation, because it might not be an app tomorrow. It might be something else. It might be a bot. It might be, this bloody thing is going to be implanted in my grandkids' heads, you know, and that's how we're going to facilitate it. So these bigger companies, why is ESPN failing now? Because they're too well off. They're protecting billions and billions of dollars. Why is, you know, the timing was perfect. So onward and upward.
Albright, how do you know when to sell? You're an investor, and how many investments have you got today? Your
Today
fund?
we have 35.
35.
35
Okay, so how do you know when to sell?
Well, okay, so it's easy to know when to sell the companies that are not performing well, right? So the only companies that we put up for sale are companies that aren't performing well and aren't growing, you know, at least 15% per annum as defined by users or customers or revenue or some sort of growth metric. Doesn't have to be dollars, but has to be growth. So the good companies that we have, we don't decide when to sell them, so someone decides when to buy them, right? So I would say theScore is a great company, right? I would never tell John to put the company up for sale unless some weird event happened, like they started trading at 500 times revenue instead of what's normal, which is 10 times revenue, right? Unlikely to happen, and if it was that kind of world, someone would come to us. So if you look at our portfolio and say it's 10 companies, we always have 20% of them, or 2 out of 10, that are extreme performers, and you never sell those companies, someone buys them. So someone picks up the phone from Square, Twitter, Facebook, Intel, whatever company it is, and says, this is an important asset for us. We can't afford to build it from scratch. You already have users, you have tech. We want your employees because they're very smart, and we're going to pay you a premium for that. So we're going to pay you what we think it's going to be worth in 3 years, as opposed to what it's worth today independently. So I guess my answer to you is we sell underperforming assets, companies that are not growing, and we can sell them and get a couple pennies on our dollar. We'll sell them for $1 on a dollar or $2 on a dollar, and then everything over and above, sort of 3 times our invested capital, we will never force the sale up.
Okay. Question on technology and business. You've asked it to John Levy, but I'd like you both to answer. Martha. Martha, you're an engineer. You study engineering.
Yeah.
Not many women in engineering, are they?
No.
20%.
30 at the school I went to, I was lucky.
Which one?
Guelph. Yeah. So question about technology. Mr. Levy, in an article written out of the group business school, you're profiled and quoted on your thoughts on technological disruption as it relates to theScore. Citing you as living in the technological moment, the article lists a number of innovations in digital media that you're watching. They are Facebook Messenger, competitive video gaming, and programmatic advertising. What I don't see listed is any innovation relating to big data or AI. Here at Ryerson, this is a topic that we're studying closely. Is this something that you've been watching, and do you have any thoughts on how these innovations will disrupt sports data and analytics, and what are you doing at theScore to stay ahead of the curve as these disruptions take place?
It's a great question, and we're probably...
Yeah, that's a hat question.
Oh, that's
I
right.
can't wait to hear how he answers it, actually.
That's a hat. There we go.
Thank you.
Okay, so you're right. We don't talk enough about that. We just do it. And basically what I mean by that is, I saw this question and I'm thinking, like, boy, you're right. Like, we don't talk about that enough. But in fact, our whole business is about the data that we're collecting. We're collecting data on our users. The whole redo of the app we just did was based upon all the data that we've been collecting and from our user base and from the new users that we're getting on other social platforms and the intelligence that we're getting, and that's how we stay ahead of the curve. So that's that whole our whole product is based on learning more and more, and with most digital companies, it's all the same. The other area it's crept into that we also don't talk about, that you're probably not familiar about, was in terms of our advertising. I have 4 engineers who do nothing but price our inventory in the programmatic market. I mean, if you'd asked me that 2 or 3 years ago, like, I'd look at myself and say, what are you talking about? So, I've got 3 guys every day. They look at our inventory because it's all automated. And, 85, 90% of all the revenue we generate in the States isn't through the old-fashioned sales guys knocking on doors to agencies or going direct. It's all through MoPubs of the world and AdXs and all these new companies who are nanosecond by nanosecond buying our inventory. So, the intelligence that we gather, the artificial intelligence that we're using to try to figure out where our user base is going and what our user base is interested in, allows us to continuously upgrade our product. So you're right, we should talk more and more about it. It's not about putting on glasses and you would think we're talking about stadium environments where people can see all sorts of data, although that gives us opportunities to feed into it and give our content into those suppliers of that sort of businesses. That's not our business in and of itself, though.
Being the co-founder of Relay Ventures, you have been involved in many projects related to mobile advancement. In an interview from 2015, right around the time when you were involved in the NIME ban, you said that you believe that Wearable should have a greater involvement in people's lives. Wearable is involved with tasks like the NIME ban, where it can not only unlock devices, but also manage your passwords, be used for transactions, managing various devices in your home, and much more. In that same interview, you said that you were most excited to see what would become of these wearables. My question to you is if you feel that wearables have developed as much as you had anticipated they would, and where you think the line is drawn with something like that, in terms of when it becomes too personal and too intrusive that it borders on being kind of frightening.
To answer your question, which is quite detailed, yeah, I was really, really optimistic about wearables. And Jawbone and Fitbit came out and they had a great success, but a very limited value prop. So in hindsight, I still believe in the long-term vision of wearables, so I believe it will be in our clothing, in our pants, in our shoes, in everything that we wear, or our glasses or whatever. But it still hasn't gone mainstream, so it's been a lot slower than I expected. The Fitbits and the Jawbones that were worth billions over the course of 3 years have evaporated because they were just sports apps, so there wasn't enough value for you to keep on wearing it. Or like I used to wear one and then I stopped wearing it because I knew when I did 10,000 steps I didn't need a wearable to tell me, and like whether or not I think it's cosmetically pretty is also another story, right? So I still believe in wearables. We're still an investor and big supporter in NIMI, which came out of U of T in the Creative Destruction Lab. And that product hasn't taken off like we thought it would too. We had pilots in banking, we had pilots in airport security, and now the only place it's going is enterprise access to networks and physical access. So there's a couple large enterprises in the Valley that are using the NIMI for one to control physical access to a building or to a room, and they're also using it to turn the computer or desktop that someone's using on and off. So one of the things that happens in corporations is people walk away from the desk, they go smoke a cigarette, they come back a half hour later, someone else could have walked up to their workstation and typed away and binned them very easily, right? So this is an automatic turn off. So as soon as the band walks away from the notebook or desktop that's sitting on someone's desk, the computer shuts off and it comes back when they get there. So that's the limited use case that we have from a company that has a use case that, you know, could be used for an ATM, could be used for banking. So they're way ahead of their time. And part of the problems for what I do for a living is timing's everything, right? So if you think something like an innovation is like God's gift and it's serving something valuable, social or not, but having a big disruption on the world, impact, or however word you want to describe it, timing's everything. So if the world's not ready for it, you need to continue product development and wait till it, you know, wait till the market's ready to pull it. So wearable still isn't there, but there's companies all over the world, you know, working on it for sports. So there's like peripherals that professional athletes wear on their skates and their shoes and their helmet and everything.
In their shirts and their pants. And
so it's not there yet. It's not like mass market. The world's not ready for it. They're not willing to pay for it. And it's a pain in the ass, like wearing those heart bands when you're working out in a gym or on a bike that measures your heart rate. Like that's like ugly and a pain and full of friction, right? But if that was in the, you know, the Nike shirt or the body armor shirt that you put on, you know, you wouldn't mind it, right? And it can automatically through IoT or Bluetooth or Wi-Fi talk to your watch or your computer or your phone.
So for cryptocurrencies such as Bitcoin and Ethereum and other initial coin offerings from small tech firms have been fairly active this year and gained a fair bit of momentum and press coverage. So an ICO is a way for startups to raise capital that bypass traditional means of venture capitalists and angel investors. Unlike an IPO, where investors receive partial ownership of the public company, in exchange for capital, an ICO investors receive the right to use the service of the issuing startup company. Just like a public company's share price increases as the firm becomes more valuable, the value of the coins also increases as the underlying service becomes more in demand. So considering that Relay Ventures focuses on software for mobile devices and having coin offering as an option for startups, do you see this trend as a threat to your company and other VCs, as this can potentially take business away from VCs? And if not seen as a threat, how might VCs leverage ICOs? And lastly, in your opinion, how sustainable are these coin offerings investor-wise and regulatory acceptance? And how can an investor differentiate legitimate startup versus companies that are taking advantage of currently unregulated cryptocurrency market?
Yeah, I think you have 10 questions all surrounding blockchain and ICOs and cryptocurrencies. I mean, it's the trendiest thing in the capital markets today, right? And it is unregulated, and all sorts of enterprises and security regulation firms have been like warned to be very careful about what they're doing here. But it's not much. It's an extension of like Kickstarter and crowdsourcing. So I don't see it as competitive. I don't see it as complementary. It's sort of like, where is it going to end up? I don't know. So there is a real purpose to cryptocurrencies, right? So I think they're efficient and they're peer-to-peer and they work really well. And initial coin offerings depends on the service that they're buying the coins for. So we have companies in our portfolio that are considering ICOs right now as a form of raising capital because it's non-dilutive. And if the coin becomes worth something, that's great. And if it doesn't, it didn't really cost the company anything. So it does compete with our capital because our firm invests really early stage. So we do seed and we do Series A, which might not mean anything to anyone in the room, but we start investing in companies pre-revenue. So they are like butting up against us, and the companies, there are some companies that are high quality. So I would say the averages are going to be no better than ours. They're probably worse. But so for us, out of every company, out of 100 companies that we invest in, 20 turn out well and 80 turn out horrible, right? In the ICO market, I'm going to say it'll be maybe 99 to 1 or 98 to 2 because the quality of the people raising the ICO is in question, and the service and the value of that service is also in question. So there's a lot of people hitting the bid and just saying like, hey, I got a great idea, I'm going to do an ICO, and there's no securities regulator involved, and let's just raise the capital as fast as possible. And the idea is really good, right? And it's purely an idea typically at that ICO level. So I believe that certain ones will survive and do very well, and certain of the current cryptocurrencies will become master currencies. It's no different than loyalty points almost. So you get like super exchanges, which are Ethereum or Bitcoin or whatever name they go by, where if a small company does a coin offering for their service and then they limited the coins, the value of the coins have to go up because demand exceeds supply, and they control the issuance of supply, right? So I don't have like a great answer for you. Like I would be incredibly careful. We're looking at them, both investing in them. We're also looking at using them for our own companies, where we own a 20% stake in. Like, why not raise capital? So we're on both sides, and we're scared and we're cautious, but we'll play as a buyer and we'll probably play as a seller too, and see where it goes. There aren't very many VCs globally that have participated in this.
So more recently, we have started to see more female sports journalists and female reporters report on the big four sports in North America. So traditionally after a game, reporters will go into a locker room to interview players to discuss the match. The issue of women being in locker rooms after a game has become an issue in the past 20 years or so because of this. Many athletes have felt uncomfortable with women being in the locker room after a game because this is when they shower, change, and decompress after a game, with some sports owners even coming out and saying directly that female sports reporters should not be conducting locker room interviews. On the other side, some women reporters have complained that in locker rooms, men will expose themselves to the reporters. So in no other profession will you find reporters or anyone in your personal space once you're done your shift. Even after this, you can go home and there's not going to be a reporter going after you. So this begs the question, should reporters, men or women, be allowed in professional sports locker rooms following a match when really all the athletes want to do is change and go home?
I'm actually surprised we're still talking about this, to be quite honest. Like, people are talented, male or female reporters, it should not matter. Yes, there are some potentially uncomfortable situations when a guy's getting out of a shower or a girl's getting out of a shower, and there should be, in certain circumstances, yes, they could be designed better so that when somebody's getting out of a shower before he does an interview or gets a chance to wrap a towel around himself or herself, there's some private space that should be honored, and I'm not involved with those decisions as to that, and that clearly should occur. But the reporting that comes out right after a game, literally, when the guys or girls are just getting out of the shower and they're still sweating and it's still fresh, I mean, you get some of the best stuff. And I'm just talking about the immediacy of the responses and some of the best stuff in terms of what happened during the game, because it's all everything's still racing through their minds. So, and it's of interest to the public. So, I think it'd be a big loss if we didn't have that sort of reporting. Now, having said that, it's got to be done right. And if anybody crosses the bounds, there should be zero tolerance for that shit, for sure. I mean, if an athlete or something takes a shot at somebody or exposes themselves in such a way that, like on purpose, there's zero tolerance for that crap. That person should be reprimanded, and the team ownership or team management should deal with it appropriately. But, in terms of that sort of reporting, whether it's a male or a female, we should all just sort of respect each other but grow up about it, because it's interesting stuff in my view.
As a person who struggles to commute through Toronto traffic on a regular basis, I know a lot of people who are very loyal to the Waze app, which helps people avoid heavy traffic by finding unconventional alternative routes through the city. Google acquired Waze in 2013 for $1.3 billion, and according to Toronto Life, you had an opportunity to go invest in them back in 2008. Now, of course, hindsight is always 20/20, but I'm curious why you passed on Waze in 2008, assuming that reporting was correct.
So the reporting is correct. The reason I didn't do it was in 2008, the way the Waze app worked, it came out of Israel, actually. So we do a fair bit of investing in Israel. But the way the app worked is it was manual. So you had to report from your car into the app by voice or by text where you were at the beginning of your journey and where you were at the end of the journey, and if you got stalled, and assuming it was legal at that time to use your phone, typing or speaking into it, not like it is today, that you would do that. So it required a lot of work from the driver or the passenger in the car. So that was one turnoff for me, so I saw that as a lot of friction. And then the second one was there was no revenue model. So in return for me being in the car and like telling you that there's an accident or that there's a cop up there or the traffic's slow or whatever, that it's red on Google Maps and Waze and everything like that, I wasn't getting rewarded, right? So this would have been like a great case for Bitcoin, for like there to be a Waze coin to say like, okay, in return for you reporting, we'll give you Waze coins and you can use those Waze coins to buy more information or more traffic or more something, right? So there was nothing like that that existed at that time. So without good fortune and the ability of foreseeing the future, which I like to pride myself in that I can do that, I didn't do that, right? So my partners in the office all wanted to do the deal and I killed it, right? So it's kind of a sore point in the office because we would have made $1 billion. So doesn't work so well, but we've had some other good ones and we've missed some disasters. But and then the technology changed, right? So now, like, I have Waze on my phone, you have Waze on your phone, we all use it, and it does it automatically, just because it's on your phone and it's open, right? So it's reporting for you. So we didn't see that. We didn't see, like, IoT or sensors and everything working in a manner that it is today. And maybe I'm the only one in the office that didn't see it, but I closed it down because there was no revenue model.
In an interview with Gordon Pitts called Digital Disruption, Staying Ahead of the Game, it becomes quite clear that you aim to be one step ahead of the competition and seem to always be looking for the next big thing in online media and communications. In the article, you mentioned that competitive video gaming is the next big spectator sport and that your company is building a strong base in the area. My question is, how exactly do you foresee eSports development in the future, and how do you plan on taking advantage of this relatively untapped nascent market?
It's a worldwide phenomena. And I'll just sort of give ourselves a little pat in the back because while other people were trying to figure out what is it, you know, is it a sport, isn't it a sport, is it just guys hanging around, guys and girls in their living room in their underwear playing video games, and you know, what we said is, I don't give a shit what it is. There's millions and millions of people all over the world playing. They're passionate about it. There's statistics. And it's not something that's going away. This is not a fad. This is a real life event that's universal. So it was very exciting for us. The trick is to figure out how to put something together that makes sense. And you see all sorts of people get excited by it and get involved in various ways. Some buy teams, some sponsor tournaments. What we decided to do right off the bat was try to take the same approach with it that we took with covering sports, which is just basically try to pull stuff together that'll be useful to people engaged in that activity. And the natural thing for us to do was to create an app for it, and that's what we did. What's interesting is that certain people do love the app and are on the app, but it's still a very desktop-oriented universe because that's what they're playing on for the most part. So, you know, it's a lot of rejigging and a lot of rethinking about you know, how are you going to be of use to the community, number one, and then number two, once you build this community and get the trust of the community, how are you going to monetize it? So there's a lot of fits and starts and stops in how to get involved with this thing. I think what we're doing now in terms of providing a lot of video content into the community seems to be working. And this is, again, taking a page out of our old book about even on the TV network. Don't do it just the way other people are doing it or the way you think it should be done. Pay attention to what they're asking you to do and then just feed it back to them. And we've seen over the course of the last 6 months, our video views on eSports growing from a couple 100,000 or 1 million to, closing in on 6-7 million video views a month now. So is it exciting? Yeah. Is that something I can monetize today? No. Is it something that's obviously useful to the community? Yes. So I think we're getting close to establishing ourselves as the premier, I don't want to say authority because it's not who we are, but the source for the community of esports, and then figuring out a way to monetize this space once we get it going. But you're seeing a lot of companies get involved and getting out of it because they're spending a shitload of money. It's like this panacea. They get excited, and then they look around and say, oh God, it's not working the way I thought it was working. I can tell you this, advertisers are dying to get to these people. They're lining up through us, and we see them all because they come to us on our sports app. So the sooner we can build this thing, I think the sooner we're going to be able to monetize it.
That's another part of the business to the other, I forget the Colombian guy's name, but that's another part of the business that has no value to the marketplace, right. But to management and insiders and board members, like, it's worth a future fortune. In our opinion.
Yeah, no, I'm just kidding. Somebody who's spending and building, they may not give a shit about the sports business, might come in and just say, here's bazooka for what you're doing in esports.
Well, you just described this really interesting, and thanks to Steve for bringing this up. And I noticed on your website there's a new app for the esport. Just you're trying to set up platform for people to streamline to watch the League of Legends and Dota online and championship tournaments. And this one I'm thinking like maybe this is an area you can look into it, because let's say, for example, League of Legends, 32 million people are playing simultaneously online, and they're creating a community.
Absolutely.
And you have an app called theScore, so many subscribers, so many people are using it just to check the score. Why not build a game on your cell phone to connect them?
A game itself?
Yes. Go through your app and give them a chance to play. Because like we just heard that people are wasting time on subways, or we don't have signals anyway, and on the TTC other vehicles.
Wow.
And then they can check, they can communicate, they can send instant message to communicate with each other. They can also play a little games, like Alco can throw a ball on his cell phone, and Chris just hit the bat, right? That's one way to do it. And like you said, it's mostly desktop, but it's not the case. That the company just bought Riot Games, who is the inventor of League of Legends, and transforming it into your cell phone and mobilize the whole thing. And you have an app. Why not just build a game like a sport-oriented, like sport theme online game for people to do this, and you have the user base already.
This is in lieu of any sort of copyright or anything like that.
Don't you have an eSports app?
So, yeah, we do actually have eSports app. And what's interesting is that what we didn't talk about, and I sort of mentioned briefly, is we're actually doing that in the sports area right now. We're building that exact type of game for sports. And it's being designed and developed out of our fantasy app not our fantasy game that I haven't talked about, but that we got involved with a couple of years ago, and then the whole daily fantasy thing blew up, and we backed off of it, but we still kept it and have retooled it and redesigned it for exactly the sort of thing that you're talking about in sports, and that's coming out very soon. Having said that, I think you're right. I think there is an opportunity to do exactly the same thing in esports. And we're going to see how this develops on the other side first. And we have a whole team now that is doing nothing but developing the games platforms to to do something like that. So it's all about the engagement. It's all about people wanting to be with the brand, people having fun with the brand, and bringing, we talk about it at the office all the time. We want to bring all these, we only have, we're the second most popular app in North America, and we only have 4 to 5 million average monthly users on the app. And then we touch another 30 or 40 million through other platforms. Think about how sports is pervasive throughout North America and the world. I mean, what we have is peanuts. We're just scratching the surface. So we're looking at all these different ways to bring them in through the funnel and then get them to be loyal to the brand and facilitate, just basically have, sports is fun. That's all there is to it.
Given that some estimates put the failure rate of VC-supported startups at 30 to 40%, often occurring after burning through a significant amount of cash for an extended period of time, what's the general methodology that you employ to determine when it's time to turn off the tap and pull the plug on a company you've invested in?
Okay, well, when we make an investment, there's actually a couple of things. Can I stand? I'm tired of sitting. Anyway.
What are you doing? He's going.
I just want to show him something. I just want to show you what's sort of right or wrong about your statistics. Is that okay, Ralph? All right.
Go. I lost track
just like
of
I'll
this
use a universe of 10 again, right, Jace? So we have like your 40%. I'm going to do like 4, 2, 2, and 2. This is like how our industry works for early stage venture guys, which is what we do. Every sort of stage of growth of a company has different statistics. But if you do the job right, this is what happens. So that's a total of 10 deals, right? So if it were 100, just add zeros or bigger and bigger. So we'll do 4 deals and invest an average $10 million in each one of these deals. And so 4 deals, we'll get $0 out of $40 million that we put in there, right? And the metrics that push that, where we decide to cut off a deal, which is the most important thing that we can do. It's not like the second most important thing is when you sell, but the most important thing is like when do you walk from a company and say, you know what, this didn't turn out, our expectations are wrong. There's no growth of users or customers or revenue or units or engagement or whatever it is that you're selling, right? So that gives you 0. And then we do another 2 that we probably get our money back, right? So just on $10, we get $2 back. Then we'll do another 2 deals or another 20% where we make 2 times our money, right? So that's 4. And then we do 2 that give you back 10, right? So that's 20, right? So you get 26. And let's say that's over the course of 5 years, which is typical for us. And so we start with $10 million. It gives you $26 million. It gives you a IRR of around 21%. That's how our business is built, right? And these 2 out of 10, that's a Waze, that's a BlackBerry, that's a Facebook, that's like all these sort of companies. Pardon? That's theScore. The score is below there. We get 1 that gives us 20 times our money. That's the score.
It's just a little too close to that 0 up top.
Sorry about that, John. So if it doesn't have the growth metrics, and those growth metrics aren't monthly, then we bail. So we'll walk on $100,000 or $10 million, no matter what the number is, it's the same operating metric. So when we first start with John, I think there were 1.5 million users or something like that. So we sat down with John and we said, like, what is progress? How many users? How long is engagement? When does revenue kick in? When do we get to profitability? And John, and they're not like, we don't, like I can't say with any company that you hit every single one of them every single month, right? But that's what we track internally. And if you're hitting like 80% of them or 75%, then we continue to play and continue to support it.
On behalf of Ryerson and the MBA, I want to thank the 2 Johns. Great class. Thank you very much.